All right, well, good evening, everyone, and welcome back. I know, again, this has been a really strange term here, the way in which we have a couple of weeks off and then we get back together again, and it's kind of unusual. That's why I usually don't like Thursday night courses in the fall semester because you have all these interruptions, but um, it is what it is, and we'll deal with it. So we've been apart for 2 weeks. It seems like 2 months to me, at least. But we're back together again tonight, and then obviously next week we'll be off again for Thanksgiving, and then be back again together 2 weeks from tonight on December 2nd. So, it kind of breaks up our momentum a little bit, but we'll try and keep that momentum going as well as we possibly can. Just a reminder, you have two items that are due by 11:59 p.m. tonight. You have your second paper, and I've received, I think, about 7 of those so far. Any papers that were submitted prior to about 6 p.m. tonight, I have had the chance to review and to return to you with some grades. So far, so good. I think of those 7 papers, all the grades have been in the A range, above 90%. And so no major issues there, but do remember to get that paper submitted by 11:59 this evening. And then the second assignment is obviously your beach board assignment number 3. That, along with your responses to classmates, should also then be posted no later than 11:59 tonight. So those 2 assignments, if you haven't turned them in yet, please be mindful that they need to be turned in this evening. A question about the paper. Is the paper for tonight to need an abstract and a reference page? It does not need an abstract. In terms of a reference page, the only time you would need the reference page for the paper due tonight is for any sources that you are using in your discussion of the societal problem or the alternatives that you are suggesting. You don't have to have a reference page for the citations you're using in the annotated bibliography because the citations are already there in the body of the paper. So only a reference page if you're using sources to support your societal problem discussion and your discussion of your 3 different alternatives. Okay. When we do get to the final paper, which is not due until December 9th, so you don't have to worry about that tonight. When we get to that paper, then we will have the requirement for an abstract as well as a reference page in that final paper. But for the one tonight, you don't have to worry about it for your citations for the annotated bibliography. So far, so good. As I said on the papers, the ones I've reviewed, the annotations are very good. The citations are good as well. There are a couple of instances where I've made comments about APA format. So, do make sure that you check APA format for your citations in your annotated bibliography section of the paper. APA is a little bit wacky in that the way in which you cite your article titles is a little weird in that you don't capitalize every single word in the article title. So, just be mindful of that, but it's not a big deduction. If you've already turned in your paper and your citations were not in complete compliance with APA, it wasn't a major deduction, so nothing to lose any sleep over whatsoever. So that's where we are currently in terms of our assignments. Then for December 2nd, since of course we don't have class next week, for December 2nd, the assignment that's due on that evening will be Beach Board Essay number 4. And for Beach Board Essay number 4, you are considering K through 12 education as a policy area, and you're recommending 3 possible solutions to address some of the problems that we'll talk about in our discussion of education policy tonight. So that's Beach Board number 4, that's due on December 2nd. And then on December 9th, our final official night of class, we have the final paper that's due, and then you also have your 5th and final Beach Board essay. But we'll talk more about those when we get together again on December 2nd. Most of the work for the final paper, once you get this second paper turned in tonight, the vast majority of the work on the final paper will already be done. Just be a matter of selecting which alternative solution you believe is the most effective and give me a justification for why you selected that alternative solution. So since you've got Beach Board essay number 4 that is due on December 2nd that deals with education policy, I thought it was important for us tonight to move education policy onto the agenda for this evening, because I don't want you to have to deal with writing a Beach Board essay on a policy area that we have not yet talked about. So the way I've envisioned tonight's session is we'll start out tonight with a discussion of economic policy. We'll take a break after that, and then we'll move into a discussion of education policy. The economic policy discussion will be lengthier and more detailed than the education policy discussion, but I do want to cover education policy tonight to give you the tools and the information you need to then be able to do a good job on Beach Board essay number 4 that's due on December 2nd. Also tonight, you may or may not have seen yet the course evaluations. There's a new process the university is using with online course evaluations, and the College of Health and Human Services has come up with their own process for how they're administering those course evaluations. And so now instructors there's actually a script, I'm not going to read it to you, but there are actually procedures that we're going to follow in doing those course evaluations. What the college and the university want is they want instructors to provide students with designated time during a class session to fill out the course evaluations. And the reason for that is that the university has found, and the research really does support this, that when evaluations migrate online, the response rates tend to be much lower than when they're done face-to-face in a physical classroom. So what they would like for us to do is to provide students with a period of time in one of the class sessions to do the course evaluations. So what I thought we would do tonight, since course evaluations are available as of today, November 18th, is that when we wrap up our discussion of education policy, to break for the evening and give you the remainder of the session where you can go and do the course evaluation. Now, obviously, you don't have to do it tonight. We're just providing class time for you to do it. You can do it at a later date, but just do make sure that you do the course evaluation when you are able to. But we will give you that class time tonight to work on that course evaluation. So that's what we're looking at for this evening. Again, the bulk of our time spent on economic policy, a little bit less time than spent on education policy, and that will probably give us all the information we really need to cover for this evening. Then next week is off, then we come back together on December 2nd. Our primary areas of focus will be healthcare policy and welfare policy. And then I would also like to reserve some time on December 2nd to at least get started with some of our presentations. So let me talk really briefly about the presentations and then how we're going to handle that assignment. So as you know from reading the syllabus and our discussion the first night of class, one of the assignments in the class is to present your work you've done in this class. So basically a presentation, very brief, less than 10-minute presentation, very informal presentation, whereby you talk to us about your societal problem, the 3 alternative solutions that you developed to address that societal problem, and then the solution or solutions that you selected and the justification for why you selected those solutions. So basically, you're just talking to us about what you did in your paper assignments. Again, they're informal, they're very brief, less than 10 minutes. You have the option, if you would like, to put together a PowerPoint presentation, and we can then share those out when you do your presentation during our Zoom session. You don't have to do PowerPoint, it's completely up to you. But what I'll do on December 2nd is I will enable the ability for everyone to share their screen. And then on December 2nd, if we could get through maybe a handful of presentations, 3 to 5 presentations on that evening, I think that would be nice to then clear the deck so that on December 9th, we can then finish up all the remaining presentations. So what I'm going to ask you to do is, if you are interested in being one of the first presenters and presenting on December 2nd, if you could just send me an email and let me know that you're interested in presenting on December 2nd, I will then, on a first come, first served basis, we'll put together a list of names. And again, the first 3 to 5 folks who want to present on December 2nd will get the opportunity to do so. And then everyone else will do their presentation on December 9th. The presentation again is less than 10 minutes, and so anywhere from 5 to 10 minutes, I think, certainly is sufficient. If you do find yourself needing to go beyond 10 minutes, it's not a big deal because we'll have the entire session on December 9th for the remaining presentations. And so, a little quick math with 20 people in the class tells me that we should be able to get through about 15 or so presentations on December 9th without a whole lot of issues. But usually they're less than 10 minutes, so about 5 to 10 minutes for the presentations. So that's the idea with the presentation. So if you want to present on December 2nd, do send me an email and I'll put together a list and we'll be able to take care of some of those presentations on December the 2nd. I think that's it for the housekeeping items. Again, I just kind of want to do a little reset of where we are since we've been apart for a couple of weeks and together tonight and then apart for another 2 weeks. So it's kind of a strange type of term for us. Okay, where I want to spend most of our time, at least in the first part of class tonight, is to discuss economic policies. So up to this point in time, we've talked about all the nuts and bolts of the policy process. We've talked about stakeholders. We've talked about agenda setting. We've talked about policy formation. We've talked about policy legitimation. We've talked about policy implementation. We've talked about how you identify stakeholders. We talked about how you generate policy alternatives. So we've really covered most of the areas, if not all the areas, that you will need to be successful when you get to 697 and you're doing the policy analysis case study. The policy analysis case study changes in 697 every year. A new case study will be prepared for next August, and so it'll run from August until the following July. So if you are planning on doing 697 next semester in the spring, the 670 case study for PPA 697 is already there. It's already on the organization Beachboard site. So if you'd like, you can go in, you can take a look at it and just kind of get a little head start with it. But when you look at the instructions for that case in 697, it should look very familiar to you because it's all the information that we've covered already up to this point in time in the class. So problem definition, stakeholders, alternative generation, alternative assessment and comparison, all those topics, you should be pretty well suited then for doing the policy analysis case once you do get to 697. But I do think it's important in a policy class to kind of move beyond that and to really get into some of the specific policy areas because each different policy area has its own idiosyncrasies and its own specific characteristics that kind of set it apart from other policy areas. Sometimes policy areas will have different types of stakeholders. Different policy areas will have different goals. Different policy areas will have different tools in order to achieve those goals. And so I think it's important to look at the major policy areas such as economic policy, education policy, healthcare policy, and welfare policy, and kind of show you how those different policy areas differ from each other. So let's start out tonight with a discussion of economic policy. And admittedly, we could teach an entire 15-week course on economic policy and still have a lot of material left to cover. So it's an immense topic. We're going to just spend about an hour or so on it. So we're just going to kind of hit the tip of the iceberg this evening. Economic policy is obviously very important because it touches on all these other policy issues. That if you want to address housing and you want to have a housing policy, you're going to have to pay for it. And so there's going to be some undercurrent of economic policy built in to that housing policy. True for healthcare policy, true for welfare policy, regardless of the area, there are always going to be some economic imperatives in terms of how you're going to pay for those policies and programs, who's going to bear the burden for paying for those through taxation. There are always going to be those types of economic elements. There are some specific goals that we try to achieve with economic policy here in the U.S. And tonight we'll talk about some of those goals we try to achieve with economic policy. And then we'll also talk about some of the tools and the approaches that are used in economic policy making to help us achieve those goals that we've identified. One of the confounding problems with economic policy is that in economic policy, we are oftentimes inundated with requests in terms of goals that we need to try and achieve, but we try and achieve those goals with very restricted and very finite resources. And the finite resources oftentimes come because of the existence of deficits and debt. So it's kind of a two-way street in that economic policy can be devised to try and affect deficits and debt, but economic policy is also affected by deficits and debt. When we have large deficits and we have an ever accumulating national debt, we have less resources available in order to carry out the essential functions and tasks of government. And so deficits and debt can really have a detrimental impact on our ability to make policy in other related policy areas. So you kind of look at economic policy as kind of being the heart of all policy making, because you really need those dollars in order to devise and implement those policies and those programs. Deficits and debt really confound our policymaking process because we live with deficits and debt on a daily basis, especially at the federal level. Now, most states will have constitutional prohibitions against running a deficit, where states will tell the state government and local governments within that state that at the very minimum, you must balance your revenues and your expenditures. And at its very heart, that's what a deficit is when your expenditures in one given fiscal year exceed your revenues. So if you're spending more money in a fiscal year than what you are taking in revenue, then you have a deficit. And most states will prohibit state and local governments from running those types of deficits. Now, it doesn't mean just because you prohibit a local government or a state government from running a deficit, it doesn't mean that there aren't ways around that. And what a lot of state and local governments will do is if they see that their expenditures are exceeding their revenues, they'll go out there and they'll borrow money. They'll borrow money and then put that borrowed money, apply it to their revenues to increase the size of their revenues to make their revenues and their expenditures balance. But if you are artificially inflating your revenues by going out there and borrowing money, you eventually will have to pay that money back. That money that you are borrowing then becomes part of your long-term debt. So it obviously is not a good fiscal practice to engage in, but it's something a lot of state and local governments need to do because of this constitutional prohibition against running a deficit. The federal government really has no qualms about running a deficit and accumulating an ever-increasing national debt. And as you'll see in a future slide, out of the past 50 plus years, we've only had 2 of those years where we've had a surplus. Every other year, the federal government has spent more money than it has taken in revenue. So when you're spending more money than you're taking in revenue, you've got finite resources for new programs and new policies. But you still have all these demands for achieving goals with new programs and policies. And so you've got these demands being placed upon you to regulate business and to regulate consumer activity, but you have less resources available in order to do it. So policy making is really all about dealing with infinite demands with finite resources. And that is, again, what really confounds the whole policy process. So let's talk about some of the goals of economic policy and some of the things we're trying to achieve with economic policy. Economic policy is meant to try and promote a variety of different goals and objectives. One goal of economic policy is regulation. So we'll pass economic policies for the purpose of trying to regulate business practices. So we'll regulate how businesses engage in commerce in order to try and protect the health and the safety of the population, to try and protect the environment, to try and protect consumers as they interact with businesses and corporations. So we do a lot of regulation in economic policy. So in terms of the environment, for instance, we may have a policy whereby we are going to fine companies that are creating pollution, and they'll have to pay these fines for every unit of pollution that's being created. That's an example of regulating through economic policy. We try and protect consumers through regulation of food to make sure that the food supply is safe. And so when we have things like listeria contamination of frozen vegetables, we'll not just go in there and regulate and set the standards for the protection of consumers, but we'll also go in there and we'll fine companies that are violating those standards. And those companies that through lack of quality control have allowed listeria to exist within these frozen vegetables that Americans are purchasing and then consuming. So we do a lot of regulation with our economic policies. A second goal of our economic policies is economic growth, to try and promote the growth of the economy. Economic growth can be measured in a variety of different ways. One very common way to measure economic growth is percent change in the gross domestic product, the GDP. And that's a really common way in which we oftentimes measure economic growth. But we'll devise these economic policies for the purpose of trying to promote and enhance economic growth. The problem is that we oftentimes see either very low levels of economic growth or sometimes even contraction. So the economy is not growing, the economy is actually shrinking. We saw that during the COVID-19 pandemic. At the height of the pandemic, we had some contraction to the economy. We saw contraction to economic growth in the 2000s in the Bush administration. We saw it in the Carter administration. So we're very familiar with contraction instead of growth in our economy. But we try and grow the economy because when we grow the economy, we then have the ability to engage in these redistributive programs. The more money you have, the more money you have to spend on redistributive programs, they become more palatable when you're in a period of economic growth. People, when they receive benefits from these types of redistributive programs, tend to support those programs and those policies. So policymaking sometimes can become a lot easier during periods of economic growth. When we're in a period of economic growth, we're bringing in additional revenue, which will allow us to minimize our deficits and sometimes eliminate deficits altogether. As I mentioned before, if you go back and look all the way back to 1969, going back to 1969, so we're looking at what, 52 years. Out of those last 52 years, we have run a deficit in 50 out of those 52 years. Only in 2 years did we actually, at least on paper, have a budget surplus. And so we've had some periods where we had contraction in the economy, like we had, like I said, in the 2000s. We have had some periods, though, of some wild growth in the economy. We saw that in the 1990s in the Clinton administration, where we had quarterly economic growth rates of somewhere in the range of 7 to 8%. That's practically unheard of with economies to have that quickly of a growing economy. The reason in the 1990s that we had a quickly growing economy was not necessarily because of proactive policies that were being promulgated by the federal government, but rather because of the growth of the internet. As the internet grew, we had what we call this dot-com boom in our economy. We had Silicon Valley doing very, very well. And we had all these companies in the Silicon Valley, all these tech companies that were making historic profits. Well, when they're making historic profits, if they're paying their taxes the way they're supposed to pay their income taxes, that then gives you a huge influx of revenue into federal government coffers. And so because of that huge influx of federal revenue, income tax revenue, coupled with some strategic cuts in expenditures, we were able to have 2 years of surplus spending as opposed to the previous years, going all the way back to 1968, where we ran a deficit each and every year. So we'll do things in economic policy to try and grow the economy. And I'll talk in a few minutes about some of the tools that we use in economic policy to try and promote economic growth. But the promotion of economic growth is a second major goal of economic policy. So we use economic policy to regulate. We also use economic policy to try and promote economic growth. A third goal of economic policy is to affect unemployment rates and to try and lower unemployment to get to the point of where we are considered to have full employment. Now, full employment does not mean 0% unemployment. We recognize from an economic perspective that as a country, we will never be at 0% unemployment. That's just statistically impossible. But full employment is what we are really trying to achieve. And full employment is usually defined as an unemployment rate of 3% or less. So when our unemployment rate is 3% or less, we consider ourselves to have full employment. And obviously, that's a major goal of economic policy. We also try with economic policy to keep a lid on inflation. And I'm sure you're all feeling the pinch of inflation today. We've seen a lot of price increases in commodities, especially things like gas, and a lot of Americans are struggling with that. Inflation is an increase in the price of a good without an associated increase in the value of that good. And so, example is if the good remains the same, but the price keeps going up, we're saying that the price is inflated and we're dealing with inflation. It could be a situation where a product is enhanced, it's made better. So, think about a cleaning product. And so we have a cleaning product, a disinfectant. And through the work in the lab, the company has come up with a cleaning product that will, instead of killing 90% of germs, will kill 99% of germs. Well, the value of that product has now gone up because it's more useful because it kills 99% instead of 90% of germs. When the value goes up, you would assume that the price would go up as well. That's not necessarily inflation because the actual value of the good itself has increased. But if that disinfectant, the value doesn't increase and it's still killing 90% of germs, but the price has gone up, that's when we really hone in on the idea that there's price inflation going on. So we engage in economic policy, and we'll talk about some of the tools we use for this, primarily to try and keep a lid on inflation and to lower levels of inflation. We also engage in economic policy for the purpose of trade balance, to try and maintain a positive trade balance. And if you watch the presidential election of 2016 and the presidential election of 2020, a lot of discussion was had about the trade balance between the US and China, or between the US and Japan. You want to try and maintain this positive trade balance in that you are exporting a higher value of goods than you are importing. If you're exporting a higher value of goods than you are importing, you've got a positive trade balance with that other country. If you're importing a higher value of goods than you're exporting, then you have a negative trade balance. We have a negative trade balance with many of our trading partners, and so that's something we try to address with economic policy. So we've got a lot of goals that we're trying to achieve with economic policy. Another goal we try to achieve with economic policy is to try and manage deficits and debt. And again, I presented this distinction between deficits and debt before. A deficit is an imbalance of revenues and expenditures in one given fiscal year. Debt is more long-term. So there are a lot of different types of debt. All of those deficits that we run year after year will accumulate into the national debt. So one of the reasons why the national debt is so big is because we've been running deficits 50 out of 52 years. So the accumulation of those fiscal year deficits will all contribute to your national debt, which is long-term in nature. But there are other reasons why we incur debt as well. One major reason we incur debt is for capital projects. And if you work at the local government level, you've probably dealt with capital projects, the construction of a new park or the construction of a recreation center. We don't have the money in year one to pay for the construction of that recreation center, so we'll borrow the money. We'll issue debt. So we'll issue a bond, and that bond will then be repaid over maybe a 20 or 30 or 40-year repayment period to give us all the money in year one that we need to go ahead and construct that recreation center, and then we pay that debt back over those 20, 30, or 40 years. So there are some good reasons for debt, such as building needed capital projects. And there are some bad reasons for debt, such as an accumulation of fiscal year deficits. But we use economic policy to try and manage these deficits and to try and manage the overall national debt. One of the problems with trying to manage deficits and debt is that we've already said we can use economic policy to stimulate economic growth. One of the ways we can stimulate economic growth, as we'll see in a few more slides, is we can cut taxes. So we have these tax cuts. Hopefully with these tax cuts, we're freeing up more disposable income for Americans, so they'll go out there and spend that money. They go out there and they spend that money, they're going to buy more goods and more products, which will then stimulate the economy. But in doing so, we're reducing the amount of revenue coming into the federal government. So it means that when we have these tax expenditures, we are going to, in turn, be reducing the amount of money that we are collecting. So our revenues are going to go down. When our revenues go down, we then run the risk of a deficit. In poor fiscal times, poor economic times, we will spend more money as a federal government in order to try and stimulate the economy. So we'll spend more money while at the same time cutting the amount of revenue that we're getting. That's going to naturally lead us to a deficit. But spending more money in poor fiscal times is what's known as counter-cyclical spending. You would normally think that you would spend more money when you have more money to spend, when your revenues have gone up. But if you really want to use economic policy to promote economic growth, you're going to be spending more money when you have less money to spend. That's what's called counter-cyclical spending. That's what leads us into fiscal year deficits. Dealing with the national debt sometimes has been considered to be an important part of economic policy. Sometimes it's not considered to be very important. So it really kind of depends upon the period of time in which we're dealing with. Over the past few years, dealing with the national debt has not been terribly politically important. We haven't worried all that much in Washington, D.C. about trying to control the national debt. In previous years, such as in the 1980s, we were very, very concerned about trying to control the growth in the national debt. National debt, and when you get such a large debt like we have today, it really can have some very negative impacts upon your economy. It means that there's less money available for private investment. And when you have less money available for private investment, you have the potential for a contraction to your economy as opposed to growing your economy. So it's usually not a good practice to carry a large national debt. We do carry a large national debt. Our debt is made up of a variety of different things at the federal level. Like I said, capital projects will go into that national debt. The accumulation of previous year deficits will go into that national debt. Entitlement programs will contribute to that national debt as well. And interest on the debt contributes to that national debt. A lot of that, all that debt that we have accumulated, all that money we have borrowed needs to be repaid, and needs to be repaid with interest. Just like if you have a house or you have a car, you're not just repaying the principal, you're repaying principal and interest. So all that interest on the national debt makes the national debt grow and grow with every passing year that we don't pay that debt off. So we usually try and use economic policy to try and manage deficits and debt, but as we'll see in a few slides, we haven't had a whole lot of success in using economic policy to manage deficits and debt. The problem with having all these different goals, whether it be regulation or economic growth or controlling inflation or fostering full employment, is that these goals oftentimes run counter to each other. And the relationship between these goals can really be a very inverse negative relationship. So you think about employment levels and inflation. This is something we're dealing with today. So we have high levels of inflation across a lot of different categories of commodities. But at the same time, we also see growth in the job market, in that we see the economy adding, I think the last quarter we added something, or last month, I think we added something like almost 600,000 jobs. When you're adding those additional jobs and people are becoming employed, clearly that employment is going to give them more disposable income. They're going to take that disposable income, they're going to go out in the economy, and they're going to spend that money. As they spend that money, that then drives the prices up. And so it's kind of difficult to work toward full employment while at the same time lowering inflation. Typically, as you move closer to full employment, prices are going to go up. And that's just a natural outgrowth of supply and demand curves in economics. Again, economic growth and inflation sometimes will conflict with each other. As the economy grows, inflation is going to go up. And it's kind of like the nature of the beast with economic growth. Deficits, as we said, can have a negative impact upon economic growth. And so you've got this interplay, if you will, between all these different goals that sometimes trying to achieve one goal will make another goal worse and vice versa. So sometimes it's not fair whenever we say, well, the federal government's not controlling inflation, but it is growing the economy. Well, growing the economy probably will contribute to some price inflation. So how do we achieve these goals? What specific types of tools do we use in economic policy to achieve these goals we're trying to achieve? Well, one tool of economic policy is what's called fiscal policy. We're going to differentiate between what we call fiscal policy and monetary policy. Unfortunately, a lot of folks conflate the two, and they don't really understand the difference between fiscal versus monetary policy. Fiscal policy deals with things such as taxing and spending, regulation, the use of subsidies to affect the economy. Those are all examples of what we consider to be fiscal policy. So to try and promote the economy and promote economic growth, we will cut taxes to, again, increase the amount of disposable income Americans have to go out there and stimulate the economy. We will spend money on certain types of programs. So you look at the most recent infrastructure bill. The infrastructure bill is intended to try and deal with the infrastructure crisis we have in this country, but it will also create a lot of jobs because you have to have people in these newly created jobs to go out there and to do these infrastructure projects, to reconstruct highways and reconstruct bridges and storm sewer systems. So it's going to create a lot of jobs. So by spending, you create jobs, you create those jobs, you then again stimulate your economy. So fiscal policy has a lot of different facets to it. Taxing, spending, we regulate business activities, again, for the purpose of trying to affect economic growth. We sometimes will provide subsidies to different parts of the economy in fiscal policy as well. So I think recently, back in the Trump administration, we had the Trump tariffs that were placed upon China and other countries. And those tariffs made it more difficult for farmers to sell their products overseas. And so we had farmers that were being hurt financially in that they couldn't sell their crops. They couldn't sell their products. And so we had a lot of farmers where their crops were just dying on the vine. And so to remedy that, the federal government came in and started providing direct subsidies, direct cash transfers to farmers to try and make up for the fiscal pain they were feeling because of these tariffs with other countries. That's a good example of a subsidy being used within fiscal policy. Fiscal policy, whether it be tax changes or spending changes, regulation, subsidies, a lot of that, if not all of that, goes through the budgeting process at the federal level. The tax code, any changes to the tax code must go through the budgeting process. Spending programs, like with the Obama economic stimulus package back in the Obama administration, had to go through the budgeting process. We will talk about the federal budgeting process in a couple of minutes and how the intricacies of the federal budgeting process sometimes will make it difficult for us to pass these types of fiscal policies. But with fiscal policy, again, we're affecting things like taxing, spending, subsidies, things such as that. With monetary policy, we are trying to deal with the amount of money that's out there in circulation in the economy. And monetary policy is used to try and control the amount of money in circulation. So there are a lot of different ways in which you can control the amount of money out there in circulation. One very obvious way, which is not a good way to do it, is you can print more money. Printing more money is not a good idea, because when you print more money, yes, you're going to get more money into your economy, but it's going to lead to runaway inflation, because there's so much money floating around the economy that people are buying all kinds of things that's going to artificially drive the price of goods up. So you're going to get runaway inflation, and you're also going to get a devaluation of the dollar. Because the more dollars you put in circulation, the less valuable those dollars become. That then will hurt you with your international trade balance, because now the dollar is worth less overseas, and that's then going to hurt your balance of trade. So we really oftentimes don't like to print more money. We saw countries like Venezuela do that, and they just kind of watch their economy implode. What we really do more frequently with monetary policy is we usually try and use monetary policy for the purpose of controlling inflation. So in Congress, we have these folks who are called inflation hawks. And the inflation hawks are very concerned about increasing prices and what increasing prices mean for the purchasing power of everyday Americans. So the primary organization that I'm sure you're familiar with that does a lot of this monetary policy is the Federal Reserve. So the Federal Reserve will use several different tools in monetary policy to try and control inflation rates. One thing that the Federal Reserve will do is they will change discount rates. We'll get to bonds in a second, but they'll change discount rates. A discount rate is the interest rate that banks charge to other banks. And so it's kind of like an internal number. Discount rates don't really affect us as average Americans directly, but the interest rates that we pay on our mortgages and our car loans will be indexed to this discount rate. So eventually a change in the discount rate will then have an impact upon the interest rates that we pay on a daily basis as average Americans. So if you change that discount rate, you can affect the amount of money that's flowing around. So if you increase the discount rate, it's going to make it more difficult for people to borrow money because interest rates are going to go up. If you reduce the discount rate, then it'll be easier for people to borrow money because the interest rates are much lower, and you're really going to stimulate the economy. So if you want to stimulate the economy and you're not that worried about inflation, you'll cut the discount rate. You'll reduce the discount rate. If you're concerned about inflation, you'll increase the discount rate in order to reduce the amount of money that's floating around out there in circulation. So that's probably the most prominent tool that we see used by the Federal Reserve to try and control inflation in monetary policy. We also see the Federal Reserve changing reserve requirements. So what I mean by reserve requirements? Reserve requirements will speak to the amount of money that banks need to keep in reserve. So they loan out money, but they can't loan out all the money they have. They have reserve requirements where they have to keep a certain percentage of the money they have in reserve and not loan that money out. Well, obviously, if you're going to increase reserve requirements, it means there's less money for banks to loan out and less money flowing around in the economy. If you decrease those reserve requirements, then banks have more money to loan out, and then more money then flows through the economy. And so reserve requirements can have that direct impact upon the amount of money in circulation. Another tool the federal government uses is the buying or selling of bonds. Again, as we had said earlier, if you're not familiar with bonds, bonds are long-term types of borrowing mechanisms. And so if you want to construct a new building, you're probably going to issue a bond, which means you're going to borrow money over a long repayment term. The federal government can either buy or sell bonds. So if the federal government decides that they're going to buy bonds, by buying those bonds, they are freeing up money in the economy. Or they can sell bonds. And if they sell bonds, then people are going to purchase those bonds. Those investors are then putting their money into bonds, and that money is not then going out there to purchase commodities out there in the economy. So whether they buy bonds or whether the federal government sell bonds will have an impact upon the amount of money that's out there in circulation. But that's what monetary policy is. It controls the amount of money out there circulating in the economy. Monetary policy usually affects the economy much sooner than fiscal policy. Fiscal policy takes some time. So you think about something like a change in tax policy, so a tax reduction act. That tax reduction act probably will not go into effect until the next tax year. And so it'll go into effect next year. So you've got a whole year delay commonly with a lot of tax policies. Now we've seen through the COVID-19 pandemic, the federal government accelerate that by making direct payments. The IRS is making direct stimulus payments and getting money directly to the taxpayers quickly. We've seen that with the enhanced child tax credit, where people have been able to get those tax credits now rather than waiting until they file taxes. But for the most part, it takes a while for tax policy to actually have an impact. Monetary policy is much, much quicker. The Federal Reserve says we're going to change the discount rate. That happens right now. It happens immediately, has an immediate impact upon people's ability to borrow money. So if you want a quick bang for your buck, it's really with monetary policy. Another tool of economic policy we see used is regulation, as we had talked about before, and regulation used to achieve economic goals. So we usually think about regulation as a way in which we protect society. So we regulate the quality of food, we regulate the quality of pharmaceutical medications, we regulate the workplace safety, we regulate all these different aspects of businesses and corporations. But by regulating all these multiple industries, we are basically increasing the cost of doing business. By increasing their cost of doing business, we are changing their decision-making calculus in terms of what to produce and how much of a good to produce. So when you increase the cost of doing business, it probably means that that corporation is probably going to increase their prices they're passing along to consumers. So things may become a little bit more expensive, and when they become more expensive, it then decreases the amount of disposable income that consumers have to go out there and spend in the economy. So there are clear economic implications whenever we engage in the regulation of businesses. Additional tools of economic policy we frequently see are things such as incentives and subsidies and industrial supports. So an example of incentive could be, in terms of tax policy, a tax abatement. So you want to attract a corporation into your jurisdiction. So you negotiate a tax abatement with that corporation, and you tell them, we will abate your property tax liability by 50% for the first 5 years that you are relocated within our jurisdiction. That is very attractive to the company, so they will then move to the jurisdiction to increase your property tax base and to provide jobs to people who live in your jurisdiction. But it means that you're going to get 50% of the tax revenue that you otherwise would get. But it is done to attract those businesses. So that's an example of an incentive being used in economic policy. Subsidies, we had talked about those before in terms of farmers. We also provide subsidies to corporations to induce them to either create more or create less of a certain type of product or good. We provide a lot of industrial supports to corporations as well. One thing that we have seen a lot of governments do is, again, to attract corporations into their jurisdiction. In addition to a tax abatement, they may provide the infrastructure that's needed for that corporation to relocate and do business in that jurisdiction. So they may say, we're going to build a business park for you. We're going to run all the sewer lines. We're going to run the electrical service, all the water lines, everything. We're going to get everything all set up. So all you need to do is just move into this industrial park. Well, that's a good industrial support to, again, encourage those industries to move into your jurisdiction. Detractors of incentives and subsidies and industrial supports will call that corporate welfare. We'll say this is the federal government giving welfare benefits to corporations rather than individuals. They oftentimes, when you're using the incentive like a tax abatement or some type of a deduction or credit, those are oftentimes also referred to as tax expenditures. A tax expenditure is when you cut taxes, it means you're going to get less revenue. And getting less revenue is equivalent to spending more money. It kind of balances out the same way, that if you're reducing the amount of money you're getting as a government, that's going to impact you in pretty much the same way as if you increase the amount of money that you are spending through increased expenditures. Now, philosophically and ideologically, the two major political parties have a disagreement over what we refer to as these tax expenditures. Democrats will argue that there's such a thing as a tax expenditure. Again, you're reducing the amount of revenue coming in, which is equivalent to spending more money. Republicans will argue there's no such thing as a tax expenditure because the money never belonged to government to begin with. That whenever there's a tax cut, that money belongs to the individual taxpayer, not to the government. So the government is not really reducing its revenue. That money was never government revenue to begin with. Again, it's kind of semantics between the two parties, but however, whichever side you come down on, the fact of the matter is that when you do reduce the amount of revenue you get as a government, it does kind of have a similar effect to spending more money in terms of your bottom line and your ability to avoid a deficit. Let's focus on tax policy, because tax policy really is a major vehicle used in economic policy to achieve our goals. Tax policy is typically very controversial because it has these really important consequences for members of the public. We had a huge tax bill back in 1986 called the Tax Reform Act. The Tax Reform Act of 1986 did a lot of different things, but most prominently what it did is it reduced the number of marginal income tax brackets in the federal income tax system. And then for those reduced number of brackets, it then reduced the rate as well. So it was a major cut to the amount of taxes, the percentage of income that a lot of Americans were paying in taxation. The old top percentage, marginal tax bracket was upwards of 90% for very wealthy Americans. That got knocked down to 37%, and we still kind of bump around 34 to 35% as that top marginal tax bracket, even for the wealthiest Americans. So you had that big tax change in the Tax Reform Act. In the Trump administration, we also had a very big piece of legislation, the Tax Cuts and Jobs Act. In the Tax Cuts and Jobs Act, we're supposed to have a streamlining of the tax system where we reduce the marginal income tax rates for different brackets of taxpayers. In addition to doing that, we also reform the system to increase the standard deduction, to make the standard deduction a more attractive option to people who used to itemize their taxes, again, for the purpose of streamlining taxation and to make it easier for people to complete their tax forms. We also took away exemptions, which was a staple of the previous income tax system, in exchange for increasing the standard deduction and increasing the child tax credit. So that was a major, major reform that we saw in the Trump administration to our federal income tax system. Our ability to use the federal income tax system and changes to the income tax system as a component of economic policy is often predicated upon the IRS and the capabilities of the IRS. Because when it comes down to it, and push comes to shove, the implementation of all these changes to tax policy will fall upon the shoulders of the IRS. The IRS historically has been very understaffed, and they just don't have enough workers in order to audit tax returns and in order to ensure tax compliance. Part of the new Biden proposal that's working its way through Congress now would be to greatly bolster the budget of the IRS, hire more IRS agents to get tougher on tax compliance with upper income Americans. So we'll see whether or not that gets through Congress, but it certainly is a way in which the Biden administration is trying to strengthen and embolden the IRS to be able to enhance rates of tax compliance. But tax policy is a major aspect of economic policy in this country. Tax policy also has to contend with the issue of regressivity versus progressivity, a regressive tax versus a progressive tax. Regressive taxes are taxes where people at lower income levels bear more of a burden than people at upper income levels. So when you look at something like an income tax, An income tax is what we call an ability to pay tax. And you probably talked about this if you've had the budgeting course. But an income tax is an ability to pay tax. So we decide how much people pay based upon their ability. Their ability is usually measured by their adjusted gross income that they're reporting on their tax forms. We then created this marginal tax bracket system and a graduated tax system in order to ensure that people at higher income levels will pay 37% or 32%, as opposed to people at lower income levels who may pay anywhere from 0 to 12%. By having those lower rates at lower income levels, we are trying to ensure what we call a progressive tax, whereby people at lower income levels are not hurt as much as people at higher income levels. So again, a regressive tax benefits people at higher income levels in that they'll pay a smaller percentage of their income in taxation than people at lower levels. A progressive tax is just the opposite of that. So the income tax with its graduated marginal tax bracket system is really designed to try and make it as progressive as possible. Now, we hear news stories all the time about corporations that pay 0% of their corporate earnings in taxation. We hear about wealthy Americans paying anywhere from 0 to 3% effective tax rates, while average Americans are paying effective tax rates of 15 to 20%. So clearly, because of the very intricate, very arcane income tax code, we really have a lot of these violations of progressivity, even though we've tried to make the income tax as progressive as possible. Other types of tax, we also have to consider this regressive versus progressive type of argument. So you look at something like the sales tax. The sales tax is a consumption-based tax. As opposed to the income tax that's an ability to pay tax, the sales tax is a benefits received types of tax. So with the sales tax, if you go in there and you buy a candy bar, you pay the tax on the value of that candy bar. You're ostensibly consuming that candy bar, and so you're deriving a benefit from purchasing and consuming that candy bar, and you pay a tax for that benefit that you are receiving. Sales taxes tend to be highly regressive in nature, because again, we're not taking into account the income level of the person purchasing that candy bar. We are just looking at the value of the candy bar. So they tend to be very regressive. The way in which you can make them a little bit more progressive is through what we call commodity exemptions. And so we say, okay, we're going to exempt certain types of food items from coverage by the sales tax. We may exempt pharmaceutical medication from the sales tax. In some states, they will exempt a certain amount, the dollar value of clothes, maybe the first $500 of clothes purchased per year from the sales tax, again, to try and make it a little bit more progressive. And that makes it more progressive because people at lower income levels have less disposable income than people at upper income levels. And we've used this term disposable income a few times tonight, but disposable income is defined as the amount of income you have left over once you have purchased the staples of life. So once you have purchased food and clothing and shelter, how much income do you then have available to purchase other non-staple things, staple commodities? Obviously, if you're making $500,000 per year, you're going to have more disposable income than if you're making $15,000 per year. So those commodity exemptions are meant to try and make the sales tax a little bit more progressive. And not to belabor the point too much, but our third type of taxes used at the local level, property taxes. Property taxes are a wealth-based type of tax, an ability to pay type of tax, in that the amount of property tax you pay will be based upon the value of your property. Well, it could very well be there's a disconnect between the value of your property and your liquid income. You may have inherited a house from a parent or a grandparent, and that house may be, several $100,000, and you're paying tax on that value, but your income per year is $15,000 or $20,000. So that type of disconnect between your defined wealth as the value of your home and the amount of liquid income you have that you will use to pay your taxes does make the property tax relatively regressive in nature. So we have some inherently regressive taxes, but we try and take them and make them as progressive as we possibly can. And that's all part of this consideration of tax policy throughout the budgeting process. So since economic policies like tax policies and spending policies have to work their way through the budgeting process, I think it's important for us to recognize the impacts that the budgeting process will have on different types of economic policy. So if you've had the budgeting course, I'm sure you're very familiar with the federal budgeting process, because we usually cover that in all of our sections of PPA 555. It's far beyond the scope of this class to get into all the details in the federal budgeting process, but I just want to kind of take you very quickly through the different phases of the budgeting process to kind of show you how the budgeting process works and how economic policies can make their way through this federal budgeting process. So the first phase of the federal budgeting process is usually referred to as the preparation phase. So in the preparation phase, we make assumptions about the amount of revenue we're going to generate and the amount of money we have to spend in order to maintain our current service levels from previous fiscal years. We'll establish the goals of what we're trying to achieve with changes to taxation and our spending plans. We'll try and clearly articulate what we're trying to achieve by spending money on this policy or on this program. What we are trying to achieve by trying to reduce taxes on this segment of society, on this group of Americans. We make assumptions about our economic conditions. And so we look at economic growth rates and changes in the GDP to determine how much additional revenue, if any, we think we're going to get in the next fiscal year, how quickly the economy is growing, or how quickly the economy may be contracting. So we make all those types of assumptions, and we produce a lot of different documents like current service estimates and baseline budget projections that we don't get into in this class during this preparation phase. But it's where we make all of our assumptions about what we're trying to achieve and our ability to achieve those types of goals. We then ask for, in preparation, agencies and departments to develop their budget requests. So they will estimate how much money they need for the next fiscal year. They'll put together their budget requests and then submit those budget requests to the Office of Management and Budget. The problem in this portion of the budget process is each one of those agencies and departments has a vested interest in trying to maximize their budgets. They're called budget maximization. And in order to maximize their budgets, they oftentimes engage in this process known as strategic misrepresentation. And strategic misrepresentation, if they need a 3% increase in their budget to accomplish their goals, they'll probably ask for a 6% increase, knowing full well that whenever this budget request goes to OMB, OMB is probably going to cut that request. Now, in putting these budget requests together, at the federal level, we very rarely go back and re-justify all the spending we've done in previous years. We engage in a decision-making model known as incrementalism, where we make small changes from one year to the next. So we'll ask for 6%, and we'll expect that OMB will probably cut us back to maybe a 3% increase over last year. OMB then collects all these budget requests, reviews all these budget requests, will sometimes negotiate with agencies and then settle on an amount that the agency will get in next year's budget. Typically, agencies are unhappy with OMB because, again, agencies have a vested interest to increase the amount of money they're getting. OMB has a vested interest to try and lower and reduce the amount agencies are getting to try and balance the budget, or at least try and make it look as close to a balanced budget as possible. So you always have agencies coming into conflict with OMB. Typically, OMB usually wins. Those negotiated settlements, if you will, in terms of the budget request, will then all go into the presidential budget, into the executive budget. That ends the preparation phase of the federal budget process. At the end of January, the president will give their address to Congress, the State of the Union address, And then usually about a week or two later in early February, the president will then turn over their budget to Congress. Once the budget goes to Congress, we then move into what's called the formulation process. This formulation process is where Congress will review the budget, all these individual requests, and then will determine what the budget should look like. So it starts in February, and this formulation process in Congress then runs through the following September 30th. It runs through until September 30th because the fiscal year runs from October 1st to September 30th. So they've got to get the budget done and then signed by the president no later than October 1st for the beginning of the next fiscal year. Never happens, but that's the way in which it's supposed to work. As Congress deals with the budget in formulation, it's kind of a two-step process in that we've got an appropriations process and we have what's called an authorization process. The appropriations process is headed up by a House Appropriations Committee and a Senate Appropriations Committee. So each body has their own appropriations committee. Each one of those appropriations committees will have 12 different subcommittees, each subcommittee working on a different policy area. So you have an education subcommittee, health and human services subcommittee, and so on and so on. In appropriations, we are dealing with what we call discretionary spending. Discretionary spending is spending that Congress has direct control over. So Congress says, for this program, we want to cut spending on this program by $50 million next year. So they cut it because they have the discretion to do that. All that discretionary spending goes through those appropriations committees. But there's a second stage to budgeting known as the authorization stage. Authorization is for what we consider to be mandatory spending. Mandatory spending is spending that Congress does not have direct control over. So things such as interest on the national debt, Congress doesn't control that. They issue the debt, they borrow the money, they have to repay it with interest. So there's no control over that. So that goes through authorization. Entitlement programs, eligibility-based programs are also considered to be mandatory spending programs. So you think about something like Social Security as an entitlement program. If Congress wants to reduce the amount of money being spent on Social Security benefits, they would have to change the eligibility requirements for Social Security. Because if you are eligible for Social Security, you are entitled legally to get those Social Security benefits. So what Congress would have to do is through the authorization process, they would then have to maybe increase the retirement age and say, we're going to take the mandatory retirement age up to 70 years old. And in doing that, you then reduce your pool of eligible Social Security recipients. And when you reduce the pool, you are then reducing spending on Social Security. So that's considered to be mandatory types of spending. That goes through the authorizations process. So you kind of have these two paths that you see in Congress through the formulation of the federal budget. The federal budget process today operates in a way that was really established back in the 1970s under this thing called the Budget and Impoundment Control Act. And the Budget and Impoundment Control Act really established this idea of appropriations committees, created a House and Senate Budget Committee, created a requirement for budget resolutions, changed the fiscal year to October 1st to September 30th. I really did a lot of these different things that we still follow these processes today. So if you want to know why we have the federal budget process we have today, you look back in the 1970s at the Budget and Impoundment Control Act. Presidents do not have line item veto authority over budgets. And so if we're building some spending policies into these budgets and Congress passes it and then goes to the president doesn't have the ability to veto out specific programs and specific policy items. The president either has to sign it or veto it. They cannot go through with line item veto power like most governors do. Most governors have line item veto authority, presidents do not. So in some ways, presidents really control the beginning of the budget process and preparation. They put the budgets together, they give those budgets to Congress. But at the end of the day, once it comes down to the fact of signing the budget, they don't have that line item veto power that governors have. What they do have is they do have a power known as impoundment, where presidents can refuse to spend the money. So a president can say, I don't agree with this program. I don't think it's something we should be putting money behind. We shouldn't be spending money on it. So therefore, I am just going to hold on to the money and I'm going to refuse to spend the money. An impoundment, presidents oftentimes use impoundments in a similar way in which a governor would use a line item veto. It made Congress very angry in 1974 in the Budget Impoundment Control Act, but there really, and we won't get into the details, but there really was very little constitutionally that Congress could do to stop those presidential impoundments. But the way the process is supposed to work is all the appropriation bills and authorization bills are all supposed to be passed by Congress by September 30th, signed by the president in time for the new fiscal year beginning on October 1st. We know that doesn't happen. And typically we may have 3 or 4 appropriation bills signed by the president by the end of the fiscal year, but we could have 8 or 9 that have not yet been passed. So what Congress does is it passes continuing resolutions. And we saw that this past year where Congress said, we're going to pass this continuing resolution just to keep the government open. So they'll say you can spend 80% of what you spent last year and you can do that for the next 2 weeks. Give them 2 weeks and then pass these remaining bills. If that doesn't work, then they'll take another 2-week period and another continuing resolution and so on and so on. When they get to about December or January and they still haven't passed those appropriation bills, they'll take them and throw them all together into one big piece of legislation known as an OBRA, an OBRA, which is an Omnibus Budget Reconciliation Act. Omnibus Budget Reconciliation Act. And again, if I misspell things in text, I apologize. I'm talking and typing. But an OBRA, Omnibus Budget Reconciliation Act. And that's usually how we make budgets today. However the budget gets done, either through an Omnibus Budget Reconciliation Act or through individual appropriation bills, once we hit October 1st, we move into the execution phase of the budget. We actually have to then go out there and spend the money. And this is where agencies and departments are then legally authorized to go out there and spend the money. But spend the money in the legally appropriated ways. And so Congress has said through appropriations, this money will be spent on this program. This money will be spent on this program. Agencies and departments then are legally required to spend that money on those different programs. That's an element of budget control that's built into execution. The execution phase will run throughout the fiscal year. So from October 1st until the following September 30th. Then once that fiscal year ends, we then move into evaluation. And in evaluation, we go back and we conduct audits to make sure that agencies and departments actually spent the money in the legally mandated fashion that they are required to spend that money in. So basically, when you look at the federal budget process, there are 4 different phases: preparation, formulation, execution, and then evaluation. The problem again is that the budget process is broken. And it's broken because we do not get the budget done on time. We usually use these continuing resolutions and these OBRAs as our primary vehicles for budgeting. Budgeting is a highly partisan type of activity now where Republicans and Democrats have a lot of trouble coming to agreement on budgets. Our budgets typically run deficits where we are incapable of spending within our means at the federal level. We continue to borrow more and more money and bring in less and less revenue. So there are a lot of broken parts to the budgeting process. All those broken parts to the budgeting process will oftentimes lead to broken economic policies. And that's why economic policy over the past several years has not been necessarily a series of successes, but we've had probably more failures than we've had successes. So let's look back over the past few years in terms of economic policy and try to identify some good examples of successful economic policies versus economic policies that unfortunately have failed. In the 1980s, in the Reagan administration, we had this movement in economic policy toward what we call supply-side economics, sometimes referred to as trickle-down economics. So in trickle-down economics, I think we had mentioned earlier in this class, in trickle-down economics, we cut the tax rates for upper income individuals and then hope that those benefits would then trickle down the economy to then help middle and lower income individuals through the creation of new businesses and new jobs. The assumption is that these upper income individuals would use the additional disposable income they have as a result of those tax reductions to go out there and create businesses and create jobs that then lower and middle income individuals could then go and occupy those jobs and stimulate the economy. We know that a lot of those benefits didn't trickle down. Some did, but I don't think that they really trickled down nearly as much as the authors of Trickle-Down Economics would have hoped. We had kind of a corollary to that in the Tax Cuts and Jobs Act in the Trump administration, where once again we saw this major overhaul of the tax system in order to reduce tax rates and liabilities at upper levels, with some more modest decreases in tax liability at the middle and lower income level, hoping that those benefits would then trickle down through the economy. Now, again, it's probably too soon for us to do a whole-scale evaluation of the success of the Tax Cuts and Jobs Act, but we do know that it did increase the deficit. And we saw that it had a big increase in the federal deficit because of the reduction in federal revenue due to those tax reductions for upper income individuals. We also know that in the process of making economic policy, especially tax policy, it's become very partisan in nature. And even when we have, like we do today, a Democratic-controlled House and kind of a Democratic-controlled Senate, because it's 50-50, but we do have a Democratic vice president who can break ties, and a Democratic president, it still has become very difficult to make tax policy and to make economic policy. And the reason for that is that there is a great variation of perspectives within the Democratic Party in Congress, especially in the Senate. And so there are some fiscal conservatives, people like Joe Manchin from West Virginia and Kristen Sinema from Arizona, who are much more conservative in their approaches to tax policy and have made it kind of difficult for Democrats to get their policies through the Senate. We also know that, again, there's a lot of polarization between the two parties, a lot of that polarization coming from political gerrymandering, but that's a topic for another class. So some of our tax cuts have been somewhat successful, but a lot have been more failures than they were successes. How about in terms of economic policies to reduce the deficit? And how well have we done in reducing the deficit? Well, clearly that has been an area of major failure for economic policy. We have not reduced our deficits. In fact, our deficits continue to grow year after year after year. They contribute to this ever increasing national debt, so much so that we kind of had a standoff a few weeks ago to increase the national debt limit. There is a debt limit that Congress places on the amount of debt that the national government can have. We were bumping up against that debt limit. And if we hit that debt limit, it means that the federal government can no longer issue debt. And if the federal government can no longer issue debt, the federal government can no longer pay for all of its other policies and all of its other programs. So we had this standoff that eventually resolved with an increase to the national debt ceiling. And so now we've raised the debt ceiling, which allows us to borrow more money. And so the cycle just seems to continue. We have been very bad at trying to reduce deficits. And again, as I showed you before, in only 2 out of 52 years have we been able to actually run a surplus as opposed to a deficit. In the 1980s, we tried to attack deficits through these things called Graham-Rubin-Hollings 1 and 2 in 1985 and 1987, 2 acts that came through Congress where we established maximum allowable debt amounts for each year and a timetable for eventually getting down to 0 for our maximum allowable deficits. The problem with Graham-Rubin-Hollings 1 and 2 is that, number one, they were unconstitutional, but we won't get into that right now. But number two, and probably the most pressing issue, is that Congress had the ability to change those debt limits, those debt ceilings, those maximum allowable deficits. And so whenever they would start to go above that maximum allowable deficit, then they would just change the target and they would raise the target. So they kept moving the target. And so instead of a reduction in deficits, we actually saw an increase in deficits. The real reason why in the 1990s, for those 2 years, we were able to achieve surplus spending as opposed to deficit spending, combination of things such as the Budget Enforcement Act, where we actually created firewalls between different categories of spending and created this system known as PAYGO. Oops, sorry, that wasn't supposed to go there. The system known as PAYGO, PAGO, in which we required that any new programs would have to be paid for with reductions in other programs. And so if you want to have spending on a new program, you got to find some way to pay for it. You have to pay as you go. That then combined with the quickly growing economy, as we talked about before, from the dot-com boom, gave us a lot more revenue, combined with some reductions in expenditures, and allowed us to get into 2 years of surplus spending. Unfortunately, then 9/11 happened, and when 9/11 happened in 2001, it pushed us right back into deficit spending again. And then with the wars in Iraq, the wars in Afghanistan, we just kept seeing these deficits increase and increase. Then with changes in tax policy in recent years, another reduction in the amount of revenue the federal government gets, another increase in the size and scope of those federal deficits. Where we have had a little bit of success has been in terms of spending policy. And in the Obama administration, there was this American Recovery and Reinvestment Act of 2009. We were dealing with an economy in recession. Through the American Recovery and Reinvestment Act, we had the creation of a lot of these different infrastructure projects whereby we created jobs and we funded a lot of money into those infrastructure projects that did help to contribute to pulling the economy out of its doldrums a bit. Now, certainly not enough to reduce deficits. We still ran very high deficits throughout the entire Obama administration, but we did see some job creation as a result of those spending policies in the Obama administration. But again, the successes that we have had in economic policy have been very minor successes. Because when you look at our goals of trying to reduce and eliminate inflation, that's not going very well for us. We look at economic growth. The economy has recovered after the pandemic a bit. We do have higher rates of economic growth, but those higher rates of economic growth are leading to higher levels of inflation. We know we have not eliminated deficits. We have not even reduced deficits. We know we have an ever-increasing national debt. We know we are still struggling to try and get budgets done on time and get them done in time for the new fiscal year. Here in California, we have had some success in terms of getting budgets done on time, but that's kind of the combination of supermajorities in the Assembly and the Senate, along with the change to Proposition 13, whereby we no longer need a supermajority in order to pass the budget. We can now pass budgets to the California state legislature with a simple majority. We still need a supermajority, though, for increasing taxation, but we only need a simple majority for getting the budget passed through the legislature. So we have, because of those structural changes, have had more success here in California getting our state budget done than what the federal government has enjoyed in terms of getting the federal budget passed in time. What challenges do we have ongoing for economic policy? I think one challenge is obviously maintaining economic growth. Like I said, the economy took a major hit with the COVID-19 pandemic, but it has begun recovering. And we've seen larger percentage growth in GDP. We've seen those economic growth rates. We've seen increases in employment levels. And so we've seen that economic growth, but that economic growth, a lot of it has been fueled through federal spending, which has then again created an even larger federal deficit and federal debt. Once that federal spending, that stimulus spending goes away, it'll be interesting to see whether or not we're able to maintain these levels of economic growth. I would assume that we're going to see economic growth lose some of its momentum after a lot of this federal spending goes away, if it does go away. Another major challenge we have in economic policy has been the growth of entitlement programs. Entitlement programs and eligibility levels have increased for a lot of our entitlement programs. And again, remember, entitlement programs are beyond the discretionary control of Congress. So these entitlement programs are part of mandatory spending. So therefore, they don't undergo the same type of scrutiny that an appropriations type of spending program would. And so these, unless we go in and change eligibility requirements, we're not going to be able to control directly the growth in spending on entitlement programs and income inequality. We continue to see this gap between the wealthiest and the poorest Americans. And this gap continues to increase each and every year. And we really have had very little success at trying to narrow that gap of income inequality. And that gap really became very pronounced again through the COVID-19 pandemic. Those at lower income levels tended to be hurt much worse because they were in service-oriented types of jobs that were really hit very hard by the COVID-19 pandemic. Middle and upper income individuals were much more mobile in terms of the types of jobs they had, and they were able to easily transition to remote-based work and really kind of not miss a beat for some folks economically. And so that just once again helped to further this gap in income equality between poorer Americans and wealthier Americans. So I think those are some of those challenges that we're going to continue to have to deal with when we're dealing with economic policy. That took us a little bit longer than I had hoped. I was hoping to get that done by about 8:10 or 8:15. I see we're kind of pushing 8:30 now. So, but I do think it's important because, again, with economic policy affects all of our other issues in policy analysis. And if you don't have the money for adequate housing, you don't have the money for addressing food insecurity, like a lot of people were talking about in their paper assignments, it's just not going to get done. And so economic policy really is the heart of all of our other policy areas. And that's why we start our discussion of specific policy areas with a kind of prolonged discussion of economic policy. I've been talking for a long time. I know we're up to 8:26 now. So let's go ahead and take a break and take a little breather, and then we'll come back and do education policy. I promise the education policy discussion will be much shorter than the economic policy discussion. All of our discussions of individual policy areas, whether it be education, healthcare, or welfare, will all be shorter than what we just did with economic policy for the reasons I've shared with you. Let's go ahead and take a break. Let's take a break until, we'll call it 8:40. So come on back at 8:40. We'll transition then into education policy. Spend about half an hour on education policy, and then I'll let you go and work on course evaluations or finish up any assignments that are due by midnight tonight. So come on back at 8:40 and we'll talk education policy. Okay, welcome back everyone. It's 8:40, so we'll go ahead and get into the second half of class. Again, I'm going to make short order of education policy, so I think we'll spend maybe a half an hour or so on it, because again, for each of these next policy areas, we won't spend nearly as much time as economic policy for all the reasons we talked about in the first half of class. So double check, make sure we are recording. Okay, we're back recording again. All right, again, to do this relatively quickly, I think it's, we all know why education is an important enough area to have policies for promotion of education. We know that education is necessary for a skilled labor force. It's necessary for educated citizenry, and so we kind of know all the reasons for it. We also know that in this country we have a strong tradition of public education. And education, at least at the K through 12 level, and now I guess we're looking at TK through 12 level, being provided primarily by the public sector, by local school districts. Now, obviously, we have some very vibrant private schools that parents can choose to send their children to, but public education's always been kind of this assumed modality, if you will, for education in this country. A lot of this focus on education policy really grows out of the 1960s and ESEA, the Elementary and Secondary Education Act, in the 1960s. Now, when we look at the roles of different levels of government, when we talked about economic policy before the break, we talked mostly about the federal government. We did make some mention to state governments, but with economic policy, you do have all three levels of government involved in economic policy. It's just the scope and the magnitude of economic policy tends to be much larger and more profound at the national level. When the national government makes a change to discount rates or sells bonds or buys bonds or changes reserve requirements, the scope of that change is immense, and it really does affect the entire national economy. States also make economic policies. We saw a lot of that through the COVID-19 pandemic and California's response to it through stimulus payments and more funding for elementary and secondary education. So the state government's also very involved in economic policy, and we know that local governments get involved in economic policy as well through the creation of redevelopment zones and tax increment financing, empowerment zones, and things such as that. So all three levels of government were involved in economic policy. And here again, with education policy, all three levels of government are involved. The difference, though, is that the areas of focus for the national government education policy are oftentimes different than the areas of focus for state governments. Because for the most part, education has typically been a state government responsibility. And the federal government really got involved in terms of something like higher education with the Morrill Act and the creation of these land-grant universities that were meant to try and foster education in practical fields such as agriculture and science. We've seen the federal government at the higher education level getting involved with things such as the GI Bill to help pay for higher education for veterans when they leave the military service, Pell Grant programs to try and increase access to higher education for folks from lower income levels. Things such as subsidizing student loans that we've seen the federal government doing, backing federal loans as they do with these federally subsidized loans. Those are all higher education types of areas of focus for the federal government. And that's really where the federal government has placed a lot of its emphasis when it comes to education policy. Another area of emphasis for the federal government education policy has been in terms of special education. And I just came off of 6 years on a local school board. And so I've seen a lot of this federal funding of special education. I've seen federal funding of things such as, Title 1s, 2, 3, 4, which are all federal funding titles that provide funds to local school districts for spending on certain student populations and in certain types of expenditure categories. So the problem that we've run into with federal government funding of special education is what we refer to as the special education bleed in the general fund budget. A lot of local school districts are not getting enough in terms of reimbursements from the federal government in order to pay for all their special education expenses. Those special education expenses need to be paid for, so they typically come out of the general fund for that local school district. Reimbursement rates from the federal government can vary, but I know for my district, we were getting reimbursement rates for special education spending in the range of about 15 to 20% of the spending we were doing was coming from federal grants. And the vast majority of the spending that was being done on special education was coming from local government sources of revenue. So even though the federal government has become very interested in special education in recent years, the reimbursement rates are very low. And so it usually ends up being a responsibility for local school districts. When you look at K through 12 education, generally funding K through 12 education has primarily been the responsibility of state governments and local school districts. One of the problems that we run into is that when we fund education, especially at the local level, most of that funding is going to come from local property taxes. When you fund education from local property taxes, you end up with great disparities in the capacity of different school districts. And so lower wealth school districts don't have the capacity to generate the same amount of revenue as a higher wealth school district. So you may have two districts located very close to each other. A high wealth district may be able to raise and spend $15,000 per pupil per year. A lower wealth district may only be able to raise and spend $6,000 to $7,000 per pupil. That creates a whole lot of inequity in funding distribution. Obviously, those inequities in funding distribution have direct impacts upon the quality of education that students are receiving. So at the state level, what a lot of states have done is they have created these, what we call foundation formulas, where they will create a formula whereby they will take all the characteristics of local school districts, put them into the formula, and then the formula will tell them how much money goes to each school district. So for instance, here in California, some of your funding that you receive as a local school district in terms of what we call your base grant will have to do with the amount of what we call at-risk students you have in your district. So an at-risk student could be a student who is in foster care, or a student who is homeless, a student from a lower socioeconomic family background, a student who might be an English language learner, a student with disabilities. Those are all what we consider to be at-risk students. And so the more at-risk students you have here in California, the more funding you get from the state for carrying out what you need to do in your daily K-12 education. Here in California, in addition to having that formula-based grant, we also then provide funding to local school districts in the form of what are called supplemental funds and concentration funds. So the more at-risk students you have, the more supplemental funds you'll get on top of your normal base grant. And then there are also what we call concentration funds. So if a local school district has more than 55% of their students falling within this at-risk student category, you can get concentration funds on top of the supplemental and the base grant funds that you're getting from the state. That's all for the purpose of trying to equalize the capacity of different local school districts. And most states have some, it won't be the same as what California does, but most states have some equalization formulas that they will use to try and deal with this problem of inequitable funding across different school districts in the state. Just about every state in the state constitution will have some provision for equal or adequate education that must be provided by the state. And so when you have these great disparities in the funding capacity of different school districts, you are inherently violating that constitutional provision. And so that's why to try and address those constitutional violations, that's why we've seen a lot of states with their education funding policy put forth all these equalization types of formulas. Here in California, a few years ago, we moved to what was called local control funding formula. And that's the formula I'm talking about for your base grant. It's referred to as LCFF, local control funding formula. In addition to the local control funding formula and education policy here in California, we also have a requirement for what's called a LCAP or an LCAP. And the LCAP is an accountability plan so that districts can be held accountable for how they are spending the money. And so in your LCAP, you have to produce goals that you want to achieve as a school district, and then strategies that you are going to spend the money on in order to achieve those goals. And so, one common goal that's required in an LCAP is parent engagement, that you need to engage in the engagement of parents and the education of children. So you then have to have strategies in terms of how you're going to be engaging your parents, and then how much money you are spending on each one of those strategies. Again, it's all meant to be as transparent as possible so taxpayers can see how their money is being spent on TK through 12 education. But again, a lot of that responsibility lies with the state and with local school districts. Local school districts are special purpose governments. Special purpose governments, they exist for one specific purpose, and that's education. As a special purpose government, it means that they are under the auspices and control, number one, of the county, and then number two, of the state of California. So this LCAP, this accountability plan that you create, must be approved by the County Office of Education. The budget that you put together must be approved by the County Office of Education before it then moves up and to be approved at the state level. So even though we say local governments are responsible for education, again, they're special purpose governments, and so they really operate under a lot of limitations placed upon them by counties as well as by the state of California. So what types of problems have we seen facing education other than funding inequities and a lack of funding? We've seen emphasis placed upon enhancing quality of education. There has been concern over the past few years from a lot of different quarters about the quality of education that students are receiving in public schools. The federal government then became very interested in trying to enhance the quality of education being provided by states and local school districts because of this perceived slip in the quality of education. We'll talk a little bit later on about No Child Left Behind and what No Child Left Behind did. But it really was an attempt to try and address this perceived slip in the quality of education that children were receiving. There's also been a perceived concern about the quality of teachers in our public school systems. We've had a lot of teachers leaving the profession even before the COVID-19 pandemic because of low pay and inadequate benefits. Because of the COVID-19 pandemic, we see even more teachers who are leaving because of being burned out through remote learning. Some teachers are leaving because of vaccine requirements. A lot of reasons why teachers have been leaving the profession. When you lose those teachers, you then don't have adequate staff to be able to provide a quality education in the classroom. And a lot of districts now are dealing with this issue. You know, how do we staff our classrooms? And I know in the district that I used to be on the board of, they're now facing a situation where they're bringing administrators back into the classroom because they've lost teachers. They're not able to hire new teachers. And so assistant principals, teachers that used to be on special assignment are being brought back into the classroom. There's also been a lot of talk before the COVID-19 pandemic about the teacher tenure system. Here in the state of California, teachers are eligible to receive tenure after 2 years of adequate performance evaluations. So as a teacher, you are usually in your first 2 years considered to be a probationary employee. But once you make it past your first 2 years, you are then considered to have tenure. And it becomes much more difficult then to dismiss teachers once they have that teacher tenure. So there's been a lot of discussion about lengthening the process of getting tenure from 2 years to maybe 4 years or even 6 years like it is at the university level. Assessing quality is really a difficult thing to do in education policy. And it's difficult because quality is such a subjective term. So when we say quality of education, are we talking about the percentage of students who are at or above grade level? Is that one way to measure quality? Probably. But are there other ways to measure quality as well? I mean, should we not just be looking at or above, should we be looking at students who are really excelling or at 2 levels above grade level? What do we really mean when we try and measure quality? The problem is because we have so many subjective definitions of quality of education, when we devise these testing requirements to try and measure quality, we end up with some biased tests. We end up with problems with test administration. We sometimes end up with districts that teach to the test just to ensure that they have the highest scores possible. Under the No Child Left Behind Act and the Race to the Top initiative, the federal government established performance standards for states to meet in terms of local district education. And so the standard that was supposed to be met is that 100% of students needed to be at or above grade level, at or above proficiency levels. Now, any statistician will tell you that achieving 100% is impossible. You're never going to achieve 100%, especially with different subgroups of your student population. So it's very difficult to achieve 100% of proficiency levels for a subpopulation such as students with disabilities. And so we saw those flaws in No Child Left Behind, and the flaws associated with having the federal government impose performance standards and then dictate the types of testing that needs to be done in order to measure those performance expectations. No Child Left Behind was replaced in recent years by a new piece of legislation, education policy known as ESSA, the Every Student Succeeds Act, and we'll talk about that more in just a minute. But basically what the ESSA Act does is it takes those responsibilities for setting performance expectations away from the national government, and it gives those responsibilities back to local school districts, under the assumption that who knows best how to achieve performance levels than the local school districts themselves. So in order to deal with funding issues, in order to deal with perceived slips in quality, both in student performance as well as teacher quality, we've seen a lot of education policy reforms over the past several years. One of those education policy reforms that has started to gain some traction is the idea of merit pay. And the idea with merit pay is that you could kind of deal with two issues at once. You can deal with your low teacher pay issue at the same time that you are dealing with your perceived slip in quality of education issue. So you're probably familiar with merit pay. It's pay for performance. It allows pay raises for teachers based upon how well they and their students are performing, linking pay increases to performance. The problem with merit pay, again, is how do you measure that performance? Is that performance based only on how students perform on standardized examinations? Because again, we know standardized examinations are not always entirely valid. We know that there is some cultural bias and implicit bias that's built into these types of assessments. And so how do you then measure these performance levels? Another problem with the merit pay type of reform is resistance on the part of teacher unions. A lot of teacher associations don't like the idea of pay for performance because they see it as being very much of a slippery slope and really a way in which you can get rid of teachers more readily and more easily based upon those perceived performance levels. Also, when you have a merit-based system, teachers association look at that as competition between their membership, and you never want to have competition between your membership when you are a teacher union. Another possible education policy reform that we've seen in recent years is to enhance certification in teaching standards. We know that there is a credentialing program in most states, including here in the state of California, that in order to be a teacher, a permanent teacher, you need to have a credential from the credentialing from the CCT here in California, and to establish uniform expectations for those credentialing, for getting that credential. Different teacher education programs certainly have different curricula. Those curricula are offered in different ways, and so there's perceived difference in quality between those teacher preparation programs. And so to try and make that more uniform and create standards for those teacher education programs. Obviously, as we've seen for many, many years, there's a very strong movement in terms of education policy reforms around the use of school vouchers, school choice, and the creation of charter schools. All these school choice, school vouchers, and charter schools are all predicated on the idea of breaking up what's referred to as the public school monopolies and to give parents choice in terms of where their students go to school. And there are a couple of different aspects here. In a lot of school districts, you have attendance boundaries, and there'll be attendance boundaries for each school in the district. And if you live within the attendance boundary of school A, you go to school A. If you want to go to school B, you would have to apply for an intra-district transfer, and some of those intra-district transfers are very difficult to get because school B may be at its capacity and can't take any more students. Another complicating factor is in some of our districts, we have these things called CFDs, these community facilities districts, where you've had development in one part of your city. And so in order to allow those developers to develop that area of your city, the developer has had to agree to build a school. And so the developer builds the school, and then there's a mitigation agreement that's signed between the district and the developer that will stipulate who gets to go to that developer created school. And it's usually only the students who live within that new development are allowed to go to that school built by the developer. So if school B, the parents want to send their students to, is in this CFD, but the parents don't live in the CFD, they're not able to get their kids into that school. And so there are these barriers in terms of school choice. So with school choice, the idea is to make it easier for parents to choose where their kids go within a district, to kind of break down some of those attendance boundary barriers. One aspect of the old No Child Left Behind Act that allowed for this was the creation of what's called a performance improvement designation for schools. So a school that was chronically underperforming and not meeting the standards established under the No Child Left Behind Act, those schools would be designated what we call program improvement schools, or PI schools. If your child attended a school that became a program improvement school, the district must then allow you to choose another school to send your child to. You can choose to keep your child there, but if you wanted to send your child to a higher performing school, you were allowed to then choose another school to send your child to. And under No Child Left Behind, local school districts would have to provide transportation for your child to this new school. That was something that really was meant to try and promote this idea of school choice and make it easier for parents to choose where their child will attend school. School vouchers allows portability. And so with a voucher, you would provide a voucher worth a certain amount of money that could then be taken to a private school and could then be applied toward the tuition of a private school. And so these portable school vouchers, another reform effort we've seen in education policy. And the creation of charter schools. Sometimes we get bogged down the terminology of charter schools. We kind of treat all charter schools the same. Charter schools are different depending upon how they are funded. Some charter schools are fiscally dependent upon the school district, and some are fiscally independent. Those charter schools that are fiscally dependent upon the district, they are dependent upon the district for their financing. The state funding will flow to the school district, and then the school district will then pass along the portion that is owed to the charter school. Those are fiscally dependent charter schools. Those fiscally dependent charter schools operate within the authority of that school district. So they operate somewhat similar to a regular traditional school, except they'll have a little bit more decision-making autonomy in terms of the teachers and the parents who are at that school, that charter school. Then your other category are fiscally independent charter schools. A fiscally independent charter school gets its funding directly from the state government. So it doesn't flow through the local school district, and that fiscally independent charter school is not as tied to the local school district in terms of rules and regulations. So fiscally independent charter schools are really run by the principal and the teachers and the parents at that specific school, as opposed to being run by a local school board. So there are different types of charter schools, but the idea behind charter schools is that you decentralize and devolve the decision-making down to the school level, and who knows better what's in the best interest of students at the school than that individual school. And that's the idea behind the creation of these charter schools, again, to try and get at that issue of a perceived slip in education quality. Another education policy reform that we've seen in recent years is a change to the testing requirements. There's a lot of question, a lot of concern about testing overuse and over-testing and testing fatigue. Again, some of the implicit and cultural biases that are incorporated within standardized testing. So we reformed the No Child Left Behind Act that required federal role in the testing of students, and we replaced it with this ESSA, this Every Student Succeeds Act. And under ESSA, what we did is we devolved decision-making over testing and performance measurement down to states and local school districts. Instead of, as in No Child Left Behind, having the national government set performance goals and expectations, we are now allowing state and local school districts to establish those goals and those performance expectations. Under No Child Left Behind, there were federal consequences for not achieving required performance levels, meaning that your district would lose money if you didn't achieve these federally imposed performance levels. We eliminated those federal consequences, and so now federal education dollars are no longer tied to meeting those federal performance expectations. And it barred the federal government straight out now, barred the federal government from imposing academic requirements on local school districts. So it very much was a devolution and decentralization of power and decision-making authority down to state and local governments, and taking those responsibilities and that power out of the hands of the national government. And so instead of No Child Left Behind now we are operating under this new ESSA piece of legislation. But that's TK through 12 education. Again, TK through 12 education today is primarily the domain of state and local governments in terms of education policy formulation. For higher education, again, higher education, it really depends upon the type of higher education institution that we are dealing with. Whereas we mandate and make education compulsory at the elementary and up to a certain part of the secondary level of education, higher education is not compulsory. Higher education is a personal choice. Despite it being a personal choice, we do know that there's great benefit to higher education. You hear it all the time that people say, today's bachelor's degree was yesterday's high school diploma. Or today's master's degree is like the bachelor's degree used to be 20, 30 years ago. So we've really had an acceleration of individuals seeking out and obtaining higher education degrees. State governments obviously have a very pronounced role to play with state universities, like here at Cal State Long Beach. We are a state university, but we don't receive as much in terms of state appropriations as we used to receive. The old adage is that we are no longer a state-funded organization. We are now a state-located organization. We have state in the name, but we have more and more of our funding is coming from non-state appropriation types of sources. But we do know that regardless whether it's a state university or if it's a private institution, one of the major concerns with college today is the cost of going to college. And you all know this, the cost has increased exponentially over the past several years, resulting in very high rates of student loans and indebtedness among students. Another major issue we're dealing with in higher education is the issue of diversity. And here in the College of Health and Human Services, the college has just launched a new initiative to try and increase the diversity of the student body in terms of, especially in terms of Black students. And there's an entire movement now in the college in order to try and enhance diversity in that way of both the student body as well as the faculty. Affirmative action has been a tool that has been used for many years in higher education up until the mid to late 1970s and 1978. Probably familiar with the Bakke case, where the Supreme Court took a very dim view of the use of any types of affirmative action quotas in the admissions process of universities. Here in the state of California, we had a proposition many years ago that precluded state universities from using affirmative action in making admission decisions. College admission really is very much of a zero-sum game, as we talked about in game theory, in that one person gets in means another person does not get in. Here at Cal State Long Beach, our admission rates are dropping every single year because we get more and more applications, and we just don't have room for all the students who are applying. For the undergraduate level, I think that we routinely get over 100,000 applications. We can usually admit, I think it's somewhere around about 10,000 or so, or 12,000. So our admission rates have really dropped well below 20-25%, which is in a lot of states unheard of for state universities. But we are really limited in our ability to use affirmative action today compared to how we were able to use it in previous years in college admissions because of that constitutional amendment passed by the voters here in California several years ago. But it doesn't mean that we do not have a lot of diversity types of initiatives that we continue to use in order to try and diversify student body as well as faculty composition. The other major problem in terms of cost of higher education, as we said, we know that the cost of higher education is increasing exponentially. We do have a lot of state programs to provide financial support for students. And so at the community college level, essentially you can go your first 2 years at a community college now, pretty much free of charge here in the state of California. We also know there are a lot of programs to help subsidize student tuition or student, we use tuition, we use fees, student fees at Cal States and student tuition at UCs. But along with those aid programs, along with that funding, also comes a lot of regulations. And I think colleges, universities are happy to see students receiving this additional aid to help them fund their education outside of loans. But it comes with regulations, it comes with strings attached. And one of the things we're dealing with now in higher education policy is how to promote attendance, how to make higher education less expensive so that people are less burdened by student loans, while at the same time kind of freeing up these institutions to be a little bit more innovative and entrepreneurial and not so much tied to the accountability strings applied by the state government that come along with increased levels of state funding. But again, when we're talking education policy, one of the primary reasons where we see reforms in education policy has been the idea of quality, to try and enhance quality, whether it be through new testing systems at the K through 12 level, whether it be in terms of changing the devolution of power between federal governments and state and local governments in terms of who is responsible for establishing these performance standards, whether it be instituting merit pay and more stringent credentialing requirements for teachers. Most of what we look at in higher education, in education policy, especially at the TK through 12 level, has really been to try and address this perceived slip in quality. I think that the problem with staffing is something that's going to continue and really accelerate over the next few months. We have seen a lot of teachers continue to leave because of COVID-19 and teacher burnout. And it really has become a crisis situation in a lot of our school districts where they just simply cannot staff their classrooms. And some districts have actually gone to enhancing and increasing their Thanksgiving break, adding a few more days on the Thanksgiving break, because they basically just don't have enough teachers to teach students in the classroom. And the problem is when you don't have enough teachers, you can't consolidate classrooms either, because we have limitations placed from the state on local school districts in terms of the number of students who can be in K through 2 classes and in grades 3 through 6 classes. And so if you're in an upper level class, you cannot have more than 34 students in the classroom. And so you can't just say, well, one of our 6th grade teachers is gone, so we're going to put 2 classrooms together. You're not allowed to do that under state law. And so I think it's a staffing issue that's really going to be something that states are going to have to really address and address very, very quickly. And by quickly, I mean before the end of this academic year, or else I don't know how much longer a lot of school districts will be able to have in-person class sessions. But I know I said I would just talk about education policies at 9:10. It's 9:15, so I almost made it. I got a little bit over by about 5 minutes, but I just want to give this information to you so you can do Beach Board essay number 4. So in Beach Board essay number 4, I'm asking you to consider K through 12 education and to offer up 3 different alternative solutions or 3 different reforms that you think could help address some of the problems that we have talked about here tonight in terms of slipping quality or in terms of funding problems in TK through 12 education. So hopefully this will give you a good background to do Beach Board essay number 4. Again, I know it's 9:15, so I think we'll stop there so that you'll have some time now so you can go and do the course evaluation if you would like in the remainder of our time tonight. Or if you would like, if you haven't turned in your paper or your Beach Board essay 3 and responses, you'll have a little bit of time now that you can go and work on those assignments. Again, if you would like to present when we get back together again on December 2nd, please send me an email. I know I've gotten 2 or 3 emails already. We'll probably do, like I said, up to 5 folks. And so I'll let you know if you volunteer through email. I'll respond to and let you know if you are on the agenda for December 2nd. But the first half of class on December 2nd, we'll do healthcare and we'll do welfare policy, try and wrap those up pretty quickly in the first half of class. Then after our break next time, we'll then go into our 5 or so presentations. Then on December 9th, we'll finish up all the remaining presentations. and that will be our last class session together. Sound good? Any questions or observations or anything? I know, again, I talked a lot tonight, but I want to get through this education information so you could do your beach board exercise. Any questions or observations on either economic or education policy? Okay, thanks, Connie. I'm glad it was helpful. Again, like I said, we could have entire classes, semester-long classes on both of these topics. So, okay. Yeah. Yeah, sure. Yeah, absolutely. Yeah, I will hang around for a few minutes once we're done here. Okay. Anything else? If not, it's been recorded, and so I'll go ahead and put the recording up on our site tonight. It should be active no later than tomorrow morning. I have carved out several hours tomorrow to work on grading these papers and beach board essay number 3. So if all goes well, and things don't always go well, but if all goes well, probably by tomorrow night, I should have all those assignments graded and feedback provided to you. Don't hold me to it, but I'll do the best I can. All right. All right. Well, I wish everyone a very happy Thanksgiving break, and we'll be back at it in 2 weeks on December 2nd. All right. Thanks a lot. Take care, everyone.